Hey everyone, welcome back to the channel. Today, we're diving deep into the intriguing world of finance, particularly focusing on the recent fluctuations in the stock market and what they mean for everyday investors and entrepreneurs like you. Buckle up, because we're going to break down some complex economic concepts into bite-sized pieces that are easy to digest. So, let's start with the elephant in the room. The Federal Reserve's recent decision to keep interest rates steady at 4.25% to 4.5%. This was widely anticipated, but what's fascinating is the Fed's outlook for 2 rate cuts later this year. Now, why does this matter? When interest rates are lower, borrowing becomes cheaper, which can stimulate spending and investment. It's like giving a shot of espresso to the economy, revving things up and encouraging both consumers and businesses to spend more. But hold on a minute. Federal Reserve Chair Jerome Powell emphasized that while the economy is strong overall, there are signs of weakness in consumer spending. This duality presents a unique challenge. How do we navigate an economy that seems robust on one hand, but shows cracks on the other? It's a classic case of uncertainty in economic forecasting, which can lead to volatility in the markets. Speaking of volatility, did you catch those stock market rallies? The Dow Jones soared over 380 points, and both the S&P 500 and Nasdaq followed suit. Why? Investors reacted positively to Powell's assurance about the economy's strength despite looming uncertainties. It's a reminder of how sentiment plays a crucial role in market movements. When investors feel optimistic, they buy more stocks. When they're anxious, they sell off shares. Now let's pivot for a moment and talk about consumer behavior, a key element in economics. Despite Powell's optimism, there are signs that consumer confidence might be waning. Surveys indicate that consumers are feeling less secure about their financial situations. This is where things get interesting. How does consumer sentiment affect small businesses? If consumers are hesitant to spend, small businesses may struggle to thrive. They might tighten budgets or delay investments, creating a ripple effect throughout the economy. And speaking of small businesses, if you're an entrepreneur watching this, it's crucial to keep your finger on the pulse of these economic indicators. With rising tariffs and trade tensions, particularly from the Trump administration's policies, small businesses could face increased costs if they rely on imported goods. So what can you do? Diversify your supply chain. Look for local alternatives or explore new markets where tariffs won't hit as hard. Now let's shift gears and talk about investing strategies during uncertain times. There's chatter about turning toward consumer staples as a safer bet. Why? These companies provide essential goods that people need regardless of economic conditions. Think food and household products. If you're looking for stability amidst volatility, consider allocating a portion of your portfolio toward these sectors. As we wrap up today's discussion, I want you to remember that understanding economic trends is vital for making informed investment decisions. The current landscape might seem daunting with potential stagflation lurking around the corner, where inflation remains high while economic growth stagnates. But there are always opportunities out there. Whether you're looking to invest in stocks or start your own business, being proactive and informed will set you apart from others who might be waiting for clearer skies before taking action. So stay engaged with financial news, analyze market trends critically, and don't hesitate to adapt your strategies accordingly. Thanks for tuning in today. If you found this breakdown helpful or insightful, give us a thumbs up and subscribe for more engaging content on finance and entrepreneurship. Remember, knowledge is power when it comes to navigating the complex world of economics. Until next time, keep striving for success.